Hello, today is Friday, September 24th. We want to spend a little bit of time today talking about the collar strategy. It's a popular point of conversation here because there is a big JPMorgan fund which puts on this collar every single month, and that open interest is something that tends to show up, or I should say the market tends to show up in the area of the strikes related to that trade. Now you can see the live market is trending up around 45.50 today. We put that in our morning note that there's big resistance at that area. A lot of traders coming out, and we think selling calls at that strike, which likely pins that level for today. What's kind of interesting here is if we dig into open interest, we're going to give you an idea of where this collar trade is positioned. So if we scan down to September 30th, the JP Morgan collar strategy tends to run in the quarterly expirations. We could go to two key strikes. So first we're going to go to the 40.65 strike. Passed it there, sorry about that. And you'll notice there are 45,000 contracts of open interest at the 4065 strike, which are trading about $1 right now. So if we scroll up, we can now see at the 44.30 strike, there are also 45,000 contracts done at that strike. So what happens here is JP Morgan sells the call and they use those funds to buy the put. And this is a hedge strategy, again, called a collar. You can actually do a little bit of research about this if you're interested. We'll post this in the notes, but you can see essentially what this fund does, and I believe there's 3 of these JP Morgan funds. They're long the S&P 500 or they're long the market in general, and then the way they hedge themselves is to put on this collar strategy. So by selling the call, they're going to give away some of their upside to protect against downside. Now there's different theories as to whether or not this is a successful idea. There's another very interesting analysis of this, and we're going to post this in the notes as well, that suggests that in general, this collar strategy is a drag on returns. It does dampen volatility a little bit, but their argument in this note is that you could simply diversify your portfolio to bonds or the like and get a very similar return. Now, of course, this analysis is going to be a little bit skewed by the fact that we've just had a rip-roaring bull market for the last several years. And so there is that extra high cost of selling that call because the market tends to really push that level. So if we step back to looking at this actual trade, we plotted it out here on the Thinkorswim platform. So if we analyze the performance of this collar, you can see here that we've loaded and what you have here is for a one lot of this position. We start off at roughly zero. Obviously, they took in maybe a slight credit, as this model suggests, but this trade initially makes a little bit of money, and then you'll notice what happens is that they start to lose on this trade. So what happens is the put starts to decay, and the call picks up in value as the market goes higher. So you're going to note here that the most pain they felt in this trade was around the 2nd of September. So there's only 1 month left. The put has lost a lot of its value. And you recall that around that same time, the market hit its high of 45.45, so it was about 100 handles in the money. So the puts lost a lot of money. The call is sharply against them. So at that point, this is a big drag on their portfolio. Now, obviously, the market sold off, but what is so fascinating about this is that they do make some money back. The pressure of that trade does alleviate some, right? The P&L of that trade flows a little bit back to zero, and it hits zero because the trade at this point is out of the money. This is when the S&P hit 4,300 last week. So now what's happening in the market? We've rallied again. This trade expires in about 6 days. So they're essentially now short roughly an at the money call, right? And the success of this trade is not as much of a drag on their portfolio as it was certainly at the beginning of September. But if we have a strong rally next week, these calls that they're short, the 45,000 calls that are tied to the 430 strike, are going to add quite a drag on their portfolio. So what's going to happen on the 30th is they're going to start rolling this trade. We've talked to some people who thought maybe they're going to roll this trade a little bit earlier, try to disguise what they're doing, and when they're doing a little bit more, might give them some favorable prices and execution. But the bottom line is that this trade, at least for this particular quarter, is looking like a drag on their portfolio. Now, it is possible, and we don't know exactly how they manage this trade, that JP Morgan could be trading deltas against this position. That means that they're monitoring the fact that this call is going in the money and they're buying extra long deltas to hedge out their risk on this trade. Or because this is a cash settled hedge, they may simply let it expire, eat the P&L by paying out the cash while their main portfolio is long equities. Now, in a few days, they're going to put this trade on again. They're going to sell calls, which are 3 to 5% out of the money, and they're going to use that to fund puts that are roughly the same distance down. That's about 3 to 5% out of the money. So because of the trade size, it'll be pretty obvious at which strikes they select because they tend to put the trade up at strange strikes like 44.30 or 40.65. And if you look at our site here, SpotGamma.com, we actually map out the gamma by strike as you can see here. And this is that 40-30 strike in here. So you can see that relative to all the other strikes in the market, these 45,000 contracts do show up as a pretty big trade. What's also interesting to note is there are a lot of puts at that strike as well. We think it's likely that those puts are somehow tied to this call position. It could be a counterpart to that collar trade or something of the like, but it is a non-standard strike. Typically, people will trade at the round numbers like 4,400 or 4,450. So we'll be on the watch for this trade next week when it goes up, and we'll be talking about it in our subscriber notes. If you have any questions, please leave them in the comments below or send us an email at info@spotgamma.com.